Hi. Well, today's video is about digital agencies' tax accounting methods. And the topic of tax accounting methods in particular can be very accounting technical or somewhat accounting nerdy. So for those in my audience who are more on the entrepreneurial operator side than on the accounting side, please bear with me on this. I'll try to keep it as relevant as I can for you. I think it is important, and if you don't have an accountant on your team watching this, then I think you should still pay attention to what I'm saying or take it into account. And so what I want to talk about is accounting methods, tax accounting methods in the context of digital agencies in that industry. And the first point that I would make is that traditionally, from an accounting method standpoint with businesses, professional service businesses in particular, we look at accounts receivable and whether we have to tax the accounts receivable or not. And so the traditional AR consideration is that your business can file, presumably, can file on a cash method of accounting for tax purposes instead of an accrual method of accounting. And by doing that, that would avoid taxing your accounts receivable. Accounts receivable from an accounting standpoint is when, of course, you sell your services. You may invoice your client. It shows up as accounts receivable. You may have performed the service, but you actually haven't been paid the cash yet. You're waiting to get the cash. From a tax standpoint, if you elect to use the cash method on your tax return, you could avoid taxing that receivable. The consideration, though, here is that there are other things in your business that also operate on a non-cash basis that may hurt or help you at the same time. So it's not a slam dunk that you should be on a cash basis for tax purposes. For example, you may have accrued expenses which are deductible when incurred instead of when paid. They could be deductible when incurred instead of paid if they meet the right criteria. And if you have those accrued expenses and you chose the cash method, you would have to wait till they were paid to deduct them. Alternatively, your revenue cycle may be different than what I described. It may not be that you do the work for a client, you bill them, and then you wait to get paid. You may get paid up front, in which case you have what we call deposits, unearned revenue on hand, that if you're on a purely cash basis would be taxable immediately. So what you really need to do is a balance sheet analysis. You really need to take a look at the question of, do I have more accounts receivable or do I have more deposits or unearned revenue? Do I have more accounts receivable or do I have more accrued expenses? Because if you have more accrued expenses and more deposits or unearned revenue, then we'd say, well, maybe you should actually file your taxes on an accrual basis because it actually benefits you from a timing perspective. You pay less tax that way than if you do it on a cash basis. But if your business really doesn't accrue expenses, you always kind of just pay them when you get the invoice, and you don't accrue them ahead of time. There's not really expenses to accrue ahead of time in your business, and you don't collect deposits from your customers ahead of time. You always bill during the service or afterwards, and you get paid after you're already done anyway. Then it may be then that would be a classic case of when using the cash method of accounting would be helpful to you, and that would be available to you in most cases. As a professional service business, professional service corporations, farming businesses, partnerships that don't have C corporation partners, S corporations, if those kind of companies, they're service businesses, they're not dealing in inventory, they can use the cash method of accounting. That's known hands down. There was a tax law change at the end of 2017. You may have heard about that. There were a lot of things that were changed, but one of the things that were changed that were taxpayer friendly is that if you do have inventory in your business, you can still use the cash method of accounting, and you can now use that cash method of accounting on your tax return as long as your gross receipts are less than $25 million. And so it's actually $25 million over a 3-year period. So there's a little more technicality to that, but that's kind of in general. If you know your business is well below that in gross receipts as a smaller business, then that's not really an issue for you, right? You can use the cash method of accounting. But again, I wouldn't jump to using the cash method of accounting until you've done your, what I'd call a balance sheet analysis, to know that your AR is your primary consideration. And in that case, I would then use the cash method of accounting on your tax return. One other point about this, using the cash method of accounting on your tax return, I'm never going to advise that you use the cash method of accounting for your books and records, for your accounting system. So your general ledger, the way you do your books, say in QuickBooks or some other kind of accounting system, should always be on an accrual basis. I believe, and my firm, when we work with clients, we always believe that you manage your business on an accrual basis. Running your books on a cash basis is misleading, and it makes it hard to do good analysis of of how your business is doing. So we are presuming that you keep your books on an accrual basis, but you're allowed to convert that to a cash basis for your tax return if you're using the cash method for your tax return for tax optimization reasons. And if you're doing that, then one thing to keep in mind is if you're really doing full accrual accounting, for projects and contracts where you're serving customers in your digital agency, then you probably have what we call work in process. You probably have income that you've been recognizing throughout the contract that you're referring to as work in process on your balance sheet. And if you're going to convert your balance sheet to a cash basis, convert your books to a cash basis, your income to a cash basis for tax purposes, the normally accepted methodology for doing that is to go to your balance sheet and reverse your accounts receivable, reverse your accounts payable or accrued expenses, your unearned revenue, reverse what we call your accruals and deferrals to calculate your cash basis income for the tax return. And when you do that exercise, the point I want to make is if you have work in process, make sure you reverse that as well. Your work in process represents income that you have recognized in your books, but you have not actually collected. And so when you're on the cash method, to get the best benefit from the cash method for tax purposes, reverse that WIP account, that work in process, along with the accounts receivable. Okay, that's it. And in another video, I'll talk further about tax strategies for digital agencies, and specifically on the accounting method side, we'll talk about some of the issues involved in using the accrual method of accounting.